Okay, so we're going to just finish the other section of chapter 12. So we had already talked about the interest payment from the issuer perspective and the buyer perspective, and we're down here talking about calling bonds. So some of this might be repeat, but I just want to make sure we have it. So calling the bond is something the corporation initiates, and the reason they do it is to protect against declines in interest rates. So similar to what's happening right now, interest rates have gone down, and if I have a stated rate that's higher than the current rate, that means I'm obligated over the life of the bond to pay that stated rate. So I would prefer not to do that if I could help it. So I would possibly call the bond, get out of that bad contract, and maybe issue more bonds at a more favorable rate, or do something else with trying to get capital for my business. So when I call bonds, to record it from an accounting standpoint, for me, I try to just kind of work outward in, because I know things and I get wiser as I keep working my way in. So I know that if I'm calling the bond, I have to pay the face amount of the bond times the call rate that was in that bond indenture. So 105%, 107%, 104% of the face value. And then I know I'm going to debit bonds payable at the face amount like I always do to get rid of that bond, because they've now been called back in and settled, redeemed, whatever word you want to use. So that's the easy part. So then the next thing that I think about is, if I had a premium on the bond payable or a discount on the bond payable, if there's any balance remaining in that account, I need to get rid of it. So to get rid of a discount, which is a normal debit, I would credit it for any balance remaining. If it's a premium, I would debit it because it's a normal credit. So similar to when I did property and I was getting rid of property, that I would remove the asset off of my books, I removed the bond payable, and then I would remove any accumulated depreciation off the books, and instead I'm removing any discount or premium on bond payable. So it's very similar concept. And then the last thing that I would do, to make it equal of course, is I would debit or credit the loss or gain on redemption. And that's whatever it takes to make the thing balance once I know all those other numbers. So that's calling a bond. Now we're going to convert a bond. And converting bonds don't happen that often, is the truth. But the bondholder initiates it, and they can convert a bond to stock. So it may be like 20 shares of stock for each bond, or 10 shares of stock for each bond. So once that stock price is greater than the conversion price, I would go ahead and, as a bondholder, and I would convert it. So the conversion price, make sure you know, is just taking the face value of the bond, which is typically $1,000, and dividing it by however many shares they get. So if it was 20 shares, then that would be, what, 50 would be the conversion price. So the bondholder is typically going to pay for the benefit of being able to convert and get this benefit of getting stock that's doing really well. And the interest expense is going to decrease then for the corporation because we basically issued it at a premium, and we know that when it's at a premium, interest expense is going down. That was on that previous slide that we looked at. So as far as the accounting goes for this, GAAP and IFRS, the International Financial Reporting Standards, treat this differently. So from a GAAP perspective, let's talk about that for the U.S. We would debit whatever amount we got for cash for the proceeds. So however much of a premium they ended up paying on it. So if they paid $520,000 on a $500,000 face value, we would do debit $520,000. As always for GAAP, we will credit the bond payable for the base amount, so the $500,000 I just said. And the difference, the credit then would be a premium on bonds payable. So nothing weird or different really there at all. And then as far as IFRS goes, they also would debit cash for the proceeds, so the $520,000. The difference here becomes their 2 credits. So if the underwriters went out and thought that they could sell these bonds for, I think the example that was probably given in the book was maybe $450,000, then they would credit bonds payable for $450,000, debit cash for $520,000, and that difference is $70,000 would be an account called conversion option, and that would have the whole $70,000 in it. So we would be $520,000, $500,000, and $20,000 on premium. They would have $520,000 of cash, bonds at $450,000, and this conversion option, which includes really the premium as well as the benefit of the conversion of $70,000. So considerably different accounting, so you have to pay attention to who you're doing the accounting for. So that wraps up really chapter 12. I would make sure for the test I knew kind of the whole bond issuance process, the difference between term and serial bonds. You've worked a lot on the journal entries for bonds, so issuing them at a discount, issuing them at a premium, paying the interest payment under both scenarios, redeeming the bond, retiring the bond, and then if I'm on the buyer side of it, the same things. When I first purchase it, all the interest I receive, as well as when it gets retired ultimately, or I sell it. And then any calling or converting of bonds, make sure I understand that. So I do get that there are a lot of concepts in there, and if you're confused by any of them, certainly shoot me a message and I'll get back to you, or we can do a Zoom or something like that. Talk to you guys later.